Welcome to our Transfer Pricing After Tax Reform webinar. Today's speaker will be our principal, Alex Martin. Now for a little bit about our company. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize our results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'm going to introduce our presenter. Alex Martin is a principal and transfer pricing practice leader at KBKG. He has 22 years of full-time transfer pricing experience working in Washington, D.C., Melbourne, Australia, and Detroit, Michigan over the course of his career. Alex has assisted companies in many industries addressing transfer pricing issues on a U.S. and global basis. As a transfer pricing economist, Alex worked for a Big Four firm for 12 years as a director, a top middle market focused firm for 6 years as a principal and 4 years as a president of an independent transfer pricing consultancy. While at the Big Four firm, he received the Chairman's Award and Coach of the Year recognition for building a Detroit transfer pricing practice. Prior to joining KBKG, Alex's transfer pricing team was named one of the world's leading transfer pricing consultancies by the International Tax Review for 3 years in a row. In addition to working with many top US and global multinational companies, Alex has extensive experience complementing those services by providing leading accounting firms. His transfer pricing practice was featured in Accounting Today for an innovative approach to partnering with professional service firms. He is well known for building in-house expertise based on his experience developing a Big Four firm's transfer pricing training program. Alex is best known for developing practical solutions for complicated transfer pricing issues, and he has published numerous articles based on his time-tested transfer pricing strategies. He continues to be a sought-after transfer pricing speaker for CPA firms and other professional service firm networks. Now I'll turn this over to Alex.
Thank you so much, and thank you for joining. I appreciate everybody joining on this afternoon. And there's a number of people from, it seems like, everywhere, so welcome to everybody. Look, I'm gonna focus on some practical issues here. Couple main points. We're going to talk about transfer pricing from a practical perspective. We're going to be assessing transfer pricing opportunities and red flags, and really some good rules of thumb. We're going to talk through some recent U.S. transfer pricing documentation guidance, and also some tax reform savings through transfer pricing planning. And now, given everybody's from, a lot of people are working from home and really trying to get their arms around how to manage in a pandemic, we'll talk about how transfer pricing fits in there. Now, appreciate that maybe some people are very familiar with transfer pricing, maybe it's a first time, but let me just jump through some fundamentals, and that we'll build on that from there. So just maybe as a starting point, why is transfer pricing important? Well, let me give you an example. Let's say we've got a German manufacturing parent company that's selling auto parts to a US distribution subsidiary. Now, if the German parent company charges too high a price for the auto parts, the IRS is unhappy. If the German manufacturer charges at too low a price, well, the German tax authority is unhappy. Now, that has a lot of implications here for companies with cross-border businesses. So just to be clear, we're talking about one company working on both sides of the border. So that is going to drive how much in taxes you pay in Germany versus how much you pay in the US. And as you may know, US corporate rates have fallen from 35% to 21%, but I think it's important to keep in mind rates as they change. So while we're talking about auto parts here, it really doesn't matter. It could be goods, services, loans, royalties, what have you. If it's a charge that crosses borders, there's a transfer pricing issue in play. All right, let's go a little deeper, a little more complicated subject. Well, what would happen if, let's take Starbucks, for example. Starbucks buys coffee beans in Switzerland, sells those coffee beans to Starbucks in the Netherlands that does some coffee roasting. They sell those roasted beans to the UK for retailers, for just kind of shops you see everywhere. And then they also pay a royalty back to the US. So really the transfer pricing question that comes into play here is, where should profits be generated? That's what transfer pricing is all about. Where should profits be generated and how much, make sure companies are paying the right amount of tax everywhere. Well, trick question here. Actually, one place I can say that taxes weren't being paid was in the UK. And the company said, well, we would be paying our fair share of taxes, but loans are really, sorry, the rent in London are really high, so we really couldn't. That's why we were losing money. Everybody else said, well, hold on a minute. You're getting profits in Switzerland, Netherlands, and back to the US. We think you're shifting profits offshore. And so they were hauled before Parliament and asked, why does Starbucks manipulate its accounts to avoid tax? So long story short, um, this is not just a tax issue. This is also a corporate reputation um, issue as well. So yeah, they paid tax once out of the previous 11 years, and well, a lot of people had some heartburn over that. Now that really drives a question: how do companies pay their fair share? Well, one thing that's nice about transfer pricing is that for almost all companies or countries, they have what's called the arm's length standard. You should be charging the same price that you would charge if you were unrelated companies. Now, great in theory, but there's also some difficulties in implementing it in practice. Um, Now, the principles are broadly similar globally, so pretty much everybody relies on the same kind of, at least principles, yeah, is probably the right term. But one thing we got to think about here is, how do you prove transfer prices are correct? And what happens if a tax auditor disagrees? Well, these are all important questions. Um, well, so when's transfer pricing an issue? Well, every US company with international operations, every international company with US operations, doesn't matter what industry, and it doesn't matter if it's goods, services, royalties, loans. Like we said before, all those are transfer pricing issues. And more countries are figuring out that this is a great way to raise revenue, well, over the years, I've seen that many more companies have been targeted, and that certainly goes down from the very largest multinationals down to the middle market and even some smaller companies too. So let's talk through how do companies approach transfer pricing, and there might be some issues here, perhaps surprising. A lot of companies don't necessarily have a good handle on the transfer prices, and it's not just because they're trying to shift profits from one place to the other. Well, let's take a company that's a pharmaceutical company in the US. Let's say they've come up with a cure for the common cold. They sell ingredients to a subsidiary in France, and they also charge for royalties to their French subsidiary. Well, obviously there's a transfer pricing issue there. The US company charges too high a price, the French tax authority is unhappy, or for the royalty charge, if they charge too low a price, the IRS is going to be unhappy. Well, believe it or not, one of the first questions I ask when talking to companies about transfer pricing is, how'd you come up with transfer pricing in the first place? And a lot of times I'll hear, well, cost plus 10. Where'd you come up with it? We just agreed to it. Well, and that might make sense for a good 10, 15 years for some companies, but when business change, your products change, your technology changes, maybe that cost plus 10 might be creating some big problems for you down the line. The other thing is that companies often um, uh, operate as one borderless business. So basically, they're trying to manufacture something for a very low price and sell it for a very high price. You may ask, well, how did you come up with the prices on the cross-border basis? Well, um, I don't care. It's just one foot, one pocket, or the other. Well, the tax authorities do care. Why? Because that price drives how much tax you pay. So there's a different thought process between how a company runs from a global perspective and then how a tax authority operates. Because if I'm a French tax agent, I may not know much about this company at all, but I do know how much tax they paid. And that's really a driving factor, and I think one of the good rules of thumb to work with here. Third is actually can be a bit uglier. And what would happen, another problem question we ask is, what would happen if we change transfer prices? Is somebody's bonus going to be affected? Because I've seen situations where, let's say the manufacturing plant, head of the manufacturing plant figures out that they can play games here. Can I, if, and they figure out they can charge $1 million higher prices to their sister company and get a bigger bonus. So a lot of times there's some diplomacy at work here. Why? Well, because somebody's paycheck might depend on their transfer prices, and so that's where some of the other problems or heartburn that comes in. And I apologize, I did not let you know the answer to the polling question is that um, all multinational companies have transfer pricing issues, regardless of where they're located. All right, so what happens if you're wrong? Well, here's where some of the confusions comes into play. What if, let's say the example here, the IRS comes in and says, you know what, we think you're shifting profits offshore. We think your royalty charge is too low, for example. So let's assume that a transfer pricing tax adjustment, in this case, is $10 million. And as you might see, it says, so you've got additional income tax of 10 million times 35%. The reason I put 35% there because tax rates, open years for audits are 35% years before tax reform. But they also apply non-deductible penalties. So you have the additional tax owed plus a non-deductible penalty. So this gets very expensive very quickly, right? $4.2 million plus interest plus US state taxes, and which is sometimes overlooked as well, do you get a refund on the other side? Well, not automatically. So effectively, you've got a double tax issue. Unfortunately, that's where things last 5, 10, 15 years to resolve these issues. So again, we're not arguing over meals and entertainment expenses, for example. You've just been ripping us off for the last couple of years, and here's your bill. And so while I'm just talking about the US issues here, multiply that by 100 plus countries that also enforce transfer pricing rules. Maybe they don't apply it in the same way, but it does get very expensive. And also, you've got two tax authorities looking at the same issue and have completely different perspectives. So really a best practice here is to make sure you're keeping everybody happy to the extent possible. Well, let's talk about another example here. Here's the IRS and Coca-Cola right now are arguing over a $3.3 billion transfer pricing case. And so it's Coke, but $3.3 billion is a lot of money for them. And the IRS audited Coca-Cola because they said, well, look, we're looking at the transfer prices, and it seems that you've got, for your foreign licensees have earned over $11 billion in over 2007 to 2009, but the US has only earned $800 million. Now, Coca-Cola says that the licensees do a lot, take a lot of risks on, do a lot of marketing effort, and therefore they should earn a substantial portion of the profits. The IRS says, well, hold on a minute. Coca-Cola in the US has done all the work, come up with all the formulas, doesn't really matter. They should get the vast majority of the profits. So that's the kind of factual issues that come into play. And just to be clear, 2007 to 2009, that's not a typo. That's an issue that's been litigated over for 13 plus years. And we can expect that they're going to apply the same type of approach from the 2007 to 2009-ish years up to 2020. So a couple other things. What's the main key here? Look, their thought process for tax authorities is that subsidiaries should not earn excess returns. You shouldn't be shifting profits offshore. And so if you're auditing a public parent company, that's their thought process. And yes, you may have a transfer pricing policy. The IRS is focused on the results more than the policy. And many countries have similar strategies here. Why? You're looking for revenue, and that's especially important in a COVID department. All right, well, how do you address this? Well, if you've come across transfer pricing before, you may have heard of transfer pricing documentation. This is your first and best opportunity to avoid a transfer pricing adjustment in the first place. It's a way to explain how your business works, what you do day to day here versus overseas, how you do your transfer pricing, and why it's reasonable. Now, in the US, it's not filed with the US tax return, but it's requested under audit. So if you get an IDR from the IRS that says, please provide your transfer pricing documentation, well, here's what they're looking for. Documentation generally includes an analysis of how the business operates in the US and overseas, an industry analysis, how does my company fit into the bigger picture? Am I a small fish in the business? Am I one of the largest suppliers, for example? A financial analysis of the client or the company and the transactions, and really an economic analysis to demonstrate why, from an economic perspective, transfer pricing's arm's length or not. Okay, well, now that's where things get a bit gray, for lack of a better term. But quite often what's used is some profitability databases or company databases to gather profitability margins. But we'll talk about that, the implications of that in just a moment here. Well, what's in these reports? And sorry, before I jump ahead, the US rules list 10 items, but really when it comes down to it, these are the 4 major items that you include, and generally that's what's required on a global basis too. All right, what's included in a study? Well, generally speaking, you've got narrations prepared through interviews. And frankly, this is my favorite part. This is why I've been doing this 20 years. You get to talk to very interesting people, and you say, hey, how did you develop this product? Why is it better than everybody else's? What kind of R&D activities, for example, are provided on a cross-border basis? Who bears the risk of things going south? And what kind of, let's say, for example, process intellectual property is utilized? Why? You're trying to get a handle on the value chain within the business and where that value ends up. And frankly, you'll hear some absolutely amazing stories, but at the end of the day, you want to take that information and have it ready to go and as an explanation of how the business operates for a tax auditor who really isn't going to necessarily know that much about your business. So you also have similar interviews with sales, marketing, finance. You got to get your arms around the business to understand how the value of this and the profits or losses nowadays comes through. One red line, obviously, that's going to be an issue here is who bears the risk of a COVID business downturn. We're all dealing with losses right now, realistically speaking, or most of us. There's some fortunate ones, but the transfer prices are also going to drive where losses are going. So who should bear the risk of that, and how do you explain it? All right, so let's go back to our penalty issues. Well, now just to be clear, you can prepare transfer pricing documentation and you prepare it by the filing date of the, in this case, US tax return. So if you prepare a report on what's called a timely or contemporaneous basis, so when your tax return is due for for the 2019 year, you need to have the report prepared by the time you file your 2019 tax return. You don't have to hand over the report at that point, but that's what makes the transfer pricing documentation effectively what's called penalty protection. Sometimes that's misunderstood. Now, ideally, you don't have a transfer pricing adjustment in the first place, and that report will hopefully get you there. But if the IRS says, you know what, no, we still disagree with your transfer pricing, here's your tax bill, you don't owe the penalties on top of it. Now, do you have to do these documentation reports every year? Well, yes, to be penalty protection, but once you do a report once, you can generally update these things on a fairly, with a lot less time and effort. There's actually been some IRS guidance that just came out on documentation, and effectively they had some heartburn over what kind of documentation or reports they were seeing. And the reason being is that they use that documentation to prioritize their audit resources, and so they're seeing too many checklists and not enough explanations of how the business works. So they don't have a good handle on things. So what's the implications of that? Well, you really need to have a plain language explanation of how the business is operating. And now we've got COVID, that's an issue too, because we need to figure out, well, what company should be bearing the risk of losses. So I did say plain language rather than plain English. The reason being is that you got to remember, you're not just doing a report for an IRS auditor, you want to do a report for the IRS and every other company or country that's out there. So, well, what happens? Everything's wonderful. The IRS comes in and says, nope, no transfer pricing adjustment here. Well, hold on a minute. What if you've overpaid tax in the US and underpaid tax elsewhere? That's where the balance comes in. How would a foreign tax auditor react to a company overpaying tax in the US? Okay, that's where you have to have your explanation, your I's dotted, T's crossed, so you explain to both. So really a best practice, and certainly something we emphasize here, is make sure your transfer pricing is acceptable to the extent possible on both sides of the border. There are some good rules of thumb there. Well, now, do you have to do a documentation study? And I think that's a real critical issue. In the US, no. If your transfer pricing is correct or overly good, they're fine with it. And you don't necessarily, so for some companies, a benchmarking study might be an alternative. So that's not your full study that we were talking about before with a very thorough analysis. This is sometimes what's called an economic benchmarking study, where you're just trying to get the pricing right and get something to target. So again, it's not all or nothing, and this kind of benchmarking study isn't as good as a documentation study, but it might be the right answer for some companies. All right, well, let's talk about global and US developments. Well, hold on a minute. So governments really need tax revenue, especially now. Well, they're going to figure out from what companies. And frankly, like we were saying in Starbucks, companies not paying their fair share of tax are great opportunities, or really one of the few things out there that they can get cash from. Um, Governments regularly audit companies that are incurring losses, especially subsidiaries, as you'll see in a couple minutes. And we also need to think on the company side, companies need to manage cash flow to fund operations. And overpaying tax in one country while you're incurring losses in elsewhere is really not an option anymore, especially in the short term for cash-strapped opportunity. Let's talk through some tax reform and CARES Act strategies, because we're talking about COVID here. Well, now, is there more to transfer pricing than compliance? Well, short answer is yes, and especially now because we're focused on cash flow. And I appreciate that U.S. tax reform is largely going to be a factor for profitable companies, but there's some implications here that you want to think about when you're trying to get a handle on your transfer pricing strategies here. If I can emphasize one thing, one relatively straightforward opportunity is to figure out how to utilize tax losses. That's where some big savings are. And with respect to COVID-19, transfer pricing can be an overlooked opportunity or impediment when it comes to transfer pricing. And we'll also talk about NOL carrybacks for the US focused audience here. Right, so really, how do you get a handle on where the opportunities are? Well, really, you want to get the 30,000 foot view or 10,000 meter view on where are profits earned within an organization. Are they showing up in the US? Are they showing up overseas? Are they split everywhere evenly? Well, that's an important issue to address. You also want to think about, well, where are the largest intercompany transactions? You want to focus your time and effort and energy on those transactions which have the biggest impact on profitability. Third, certainly what we're doing a lot of discussions right now, where does the company need cash? For a lot of private equity companies, for example, they want to have cash back where the debt is so you can pay off your debt faster. Now, and how can companies, how can intercompany prices change to optimize that cash flow? And we're all going to talk about, hey, sometimes you can revisit your transfer pricing policies for improving cash flow. So best practice, again, looking for the 30,000 foot view here. You want to look at the country by country income statement in each location. And I would suggest looking at it for the last 3 years. Why? Well, generally speaking, that's going to be the open tax audit years. And the US and other countries also obviously have the similar types formed, but you want to look at the 54, 71, 72s. Basically, it's all of those forms that disclose intercompany transactions. And if I can just add as an aside, be very careful here. If you've got a client or your company has intercompany transactions in the US and you don't disclose that you have intercompany transactions, the fines recently moved up from $10,000 to $25,000 per form per year. So it gets very expensive. Fourth, look at the US and foreign transfer pricing documentation. That's really important too. Why? You want to understand, well, if there was an audit, what does it say? And should it be changed? And second, hey, if there's not a report, maybe there's a problem there. And in working with CPAs, I generally say, well, look, hold on a minute. If you look at your documentation of the client, you'll have a good handle on how the business operates on a global basis, or perhaps better yet, how they see the business working. And I just find some very fascinating, interesting facts about these businesses just from reading these types of reports. And at the end of the day, if the report doesn't make sense to you, it's not going to make sense to a tax auditor, and that's just as important as anything. Let's talk about tax losses. All right, now this is going to sound, well, I think particularly relevant for a lot of companies, but let's say we've got a German parent with a US subsidiary reseller, And in this situation, they've got $70 million of US revenue. They purchase in euros, but they're facing a downturn. Revenue's gone from 75 million down to 65 million in 2020. Well, let's also assume for this case that the parent company is currently earning $6 million in profit at a 30% rate. So about $1.8 million in tax. All right, well, let's think through this. If I'm a tax auditor, I'm looking at this saying, well, hold on a minute. I'm auditing a subsidiary company in the US and they're incurring a loss. Does that make sense? Well, maybe not. Because quite often a good rule of thumb for the tax auditors is say, well, subsidiaries shouldn't incur losses. Now, I'll have some disagreements on that from time to time, but that's quite often their starting point. So if I'm looking at this US company and I've got a earnings before interest and tax, which is a great way to benchmark things or figure out how big of an issue one way or the other. In this case, we've got in 2020, we've got a $2.5 million loss. All right, well, could we do something about that to save some money? Well, I think so. And here's why. From an audit risk perspective, they're thinking, well, would an independent distributor in the same types of situation continue to purchase products and incur losses? Well, again, their rule of thumb is probably not. Well, what if you reduce the transfer price of products by $2.5 million? Well, in Germany, the taxable income will go from $6 million to $3.5 million. So $2.5 million transfer pricing adjustment to correct transfer pricing results in $750,000 in cash tax savings. That's a big dollar amount. And we're just trying to sort things out to get to the right answer. So in taking a look at tax losses and where they're located is going to be can be a big savings here. What are some best practices here? Well, realistically, if you're looking at, and obviously I'm looking at overall profitable companies, you want to review annual profit margins of each subsidiary. If there are losses or large tax net operating losses, there's a subsidiary tax risk, possibly. If there are large profits in the subsidiaries, like the Coca-Cola example, well, that's probably that's more likely to be a parent tax risk. Again, that's not the end answer. There may be some very important factors that go into play here. And you certainly want to explain, well, yes, I've got losses, but they're commercial driven, not transfer pricing driven. Those are the kind of things you get ahead of with your transfer pricing documentation. The other thing is you want to look at all open tax years. And under the CARES Act, we'll talk a little bit about maybe it makes sense to have more tax losses in the US because you can carry back those losses in the FOR. All right, let's talk about US tax reform. Normally you should be showing up on your screen momentarily. Now, certainly over the last year, I've been harping on this quite a bit. And the reason being is that under the Tax Cut and Jobs Act, the tax rate's gone from 35%, or federal tax rate has gone from 35% to 21%. There's also some export income can be taxed at 13%, 13.125. And the other push they've made here is to make holding intellectual property offshore, like the Cayman Islands, for example, or Ireland, less beneficial. So that's a thought process. Why was it designed this way? Well, they want to incentivize US investments in the value chain. They want to incentivize US exports with lower tax rates. But for profitable companies, it's also an opportunity for tax savings. We'll put some numbers behind this in just a moment. All right, let's put down together an example. Let's say we've got a U.S. company that has $10 million worth of taxable income, and that is charging a royalty to a subsidiary. And after that royalty rate, the foreign subsidiary is earning $5 million in taxable income. So in the U.S., U.S. taxes payable are $2,100,000, and in the foreign country there's $1.5 million. So what would happen if the transfer prices were changed? For example, increasing the royalty from $2 million to $3 million. All right. Well, there actually could be some tax savings here. The reason being is that I don't want to say it's a rate arbitrage, but there has to be substance behind this. But what I find is that as companies have invested heavily in more R&D, they're able to make more profitable products or services or software, what have you. The royalty, if you increase the royalty charge in this situation from 2 million to 3 million, and I appreciate this slide's a little busy here, but the $10 million that you see here under the US company parent goes to $11 million. So you're paying more tax in the US at a 21% rate and less tax at a 30% rate. So just from this adjustment alone and correction, we'll say, there's a $90,000 annual tax savings. Well, that's a big amount. You may say to yourself, well, you can't just do that. Well, realistically, for those companies that have done any kind of tax planning, most of them have tried to minimize their U.S. tax footprint. Again, being pragmatic here. And also, a lot of companies have been investing in their U.S. operations, so maybe it makes sense to increase that royalty, increase that cost of goods sold. Again, you got to have substance here, but I think a lot of companies maybe not necessarily be aware of this, where there is some tax savings, which obviously is very important. Now, let's dig a little deeper. All right, you may have heard of GILTI under the U.S. tax return. I'm sorry, GILTI under U.S. tax reform, but there's also something called the Foreign Derived Intangible Income. And effectively, it's an export incentive. But I find it's another overlooked planning opportunity. Why? Well, once you reach a certain threshold, sorry, that should say more companies are just figuring out the calculation. It is complicated. But once you get over a certain profit threshold, you get your tax, that excess tax or tax on exports is actually taxed at 13.125% rather than 21. That's a big dollar. Well, all right, so let's take the exact same example, and instead of the royalty being charged at 21%, it's taxed at it's taxed at 13.125. That makes a real big difference because, again, for a lot of companies, they've tried to minimize, if anything, their footprint, or they haven't really thought about this, and the tax savings can be substantial. Why? Well, for certain export income, it can be taxed at 13% rather than 21. So where does that leave us? Well, all right. Well, let's think about things from an inbound. Sorry, let me talk about inbound companies briefly. Taking the reverse situation, for profitable companies, hey, maybe it makes sense to reduce inventory prices and royalties. In other words, more income in the US versus overseas. And again, it's for a lot of companies, it's not some kind of aggressive tax scam. It's the companies change, the businesses change, maybe the transfer prices should be changed as well. So again, more US income at 21% and at a higher rate overseas, you're going to get a cash tax benefit from it. And I think there was a great question before. Customs rules are different than transfer pricing rules, but there may also be a customs duty savings from lower the transfer prices as well. Be very, very careful on here because you can get to whipsawed here. Let's talk about COVID, and I'm going to answer a question that just came through on revisiting transfer pricing strategies. Well, like we said before, governments are looking for revenue, right? Multinationals are great targets. It's a big dollar amount. And frankly, one of the better arguments you'll see, especially for when tax authorities are auditing foreign subsidiaries, is that they argue they should be earning profits. Well, why? Well, they say the parent company should be bearing the risk. They have more of the financial wherewithal or financial resources to bear those losses. And I expect to see this quite often, certainly over the next couple of years, especially when we've got COVID. So really, as an aside, revisiting the transfer pricing strategy now, especially during 2020, while we're trying to get a handle on where profits and cash needs to be, is really essential. I normally suggest to clients in more normal marketing, more normal business events to look at things on at least a quarterly basis, so you can see how profits and taxes are ending up. And so you don't have a big surprise at the end of the year. I think with COVID, we're gonna have to look much more often, monthly, quarterly, just to see where cash is needed and where profits are ending up. If you're preparing transfer pricing documentation, you need to be able to explain why losses are commercially driven rather than transfer pricing problems. Well, what does that mean? Well, again, if you're a tax auditor, I don't have a good handle on how your business, but I do know how much tax you paid. If you're better prepared to explain why the company has incurred a loss and quantify that, you're going to be far better positioned. And remember, this isn't going to be audited this year. It's going to be audited 2 years from now, maybe 3, maybe longer. But if you got your ducks in a row, your I's dotted, T's crossed here, you're going to be better positioned to address us when and if there is a transfer pricing audit. Now, for the U.S., if you might be aware of the CARES Act, and effectively it was a number of provisions pulled together to make sure to help companies not from prevent companies from collapsing and try to keep the economy afloat. And one of the major changes here is that tax net operating losses can be carried back 5 years. And if you paid tax in those, at some point during those 5 years, you may be able to get a refund up to 35%. Now, again, this is going to be very complicated in that there's a lot of factors that go into play here, but changes to transfer pricing may be warranted due to the pandemic, and there might be an additional benefit in that transfer prices are going to drive, actually might increase your tax NOLs in the US. What's the thought process here? There could be here's the strategy, really. We've got a US company with X dollars of losses. We've got a foreign subsidiary with Y losses. The total company losses, let's say, for example, $1 million. The transfer price not only affects where profits end up, it's also going to affect where losses end up in this situation. Now, if you've got more losses, you can carry more. You may be able to carry back losses to those years where you did pay a lot of tax, 2015 to 17, for example. You might be able to get 35% back on those, the dollars that you carry back as a refund on those taxes paid back in 15 to 17. That may be a lot of cash flow. Now, there are some serious complications here in that if you're paying things like foreign tax credits or you have alternative minimum tax, I'm not trying to make this overly complicated, but there is some tax planning that goes into play on this type of situation. That being said, the CARES Act was developed or enacted to help companies get cash flow, and this is something that may be an option that an opportunity you can take advantage of now during 2020 that can result in some badly needed cash flow to keep the operations afloat. We all know now, hopefully, transfer pricing rules apply to all multinationals. I strongly suggest using off-the-shelf material. Don't create something new, but you want to look at how a tax auditor is going to review your results, both in the US and overseas. So off-the-shelf income statements, off-the-shelf tax returns. I would strongly suggest focusing on cash flow optimization with COVID. That's what's needed. There are transfer pricing savings through utilizing tax losses. That also helps you on the audit perspective. There are also some transfer pricing savings for profitable company with lowered US tax rates. And if you do make changes to transfer pricing, and actually even if you don't, depending on the size of the company, you want to have some kind of documentation in place to justify your documentation or profits or what have you in case there's an audit, again, in the US and overseas. And again, if it doesn't make sense to you, it's not going to make sense to a tax auditor. It's a great rule of thumb. I guess a question about wholesalers that just came in. Yes, if a wholesaler operating, let's say in the US, that's buying from China, for example, if the wholesaler is owned by the parent company or has a relationship, cross ownership, yes, there's a transfer pricing issue. Is there a rule of thumb on ownership? Sorry, I've got about 4 or 5 minutes here if you have questions to fire away. If I haven't covered anything in particular here. You may think in the US, it's the reality of control as opposed to a strict ownership test. So if one company can control the pricing or profits of on cross-border transactions, that's effectively a transfer pricing issue. Let's see. What do you do about tariffs? Well, I think that goes into how you explain how your business works in your transfer pricing documentation. So if tariffs have terribly impacted your business, you want to have that explanation together. We lost a $2 million deal because of tariffs, and therefore here's why our results are below what was anticipated. That kind of factual explanation that's ready to go, ready to explain, is going to be a big deal. Are there safe harbor rules under transfer pricing? Yes, in certain countries, but I find that they're pretty high at the end of the day. So let's say India, for example, has some safe harbor rules for providing call center, for example. You need to have cost plus 15-20% for those services. Well, that's great, but the safe harbors they give are very generous to the Indian government, for example. There is a safe harbor for intercompany loans in the US for US dollar denominated loans, for example. Question for you, does the IRS only investigate multinational companies that have subsidiaries in the US? No, they look both inbound and outbound. So it's probably easier for them, I find, for them to audit foreign-owned companies just because they've got if not a template, they've got a good handle on what kind of profits a subsidiary should earn. But they certainly go after US companies with outbound operations. Why? Well, quite often for companies with a lot of intellectual property, for example, they're trying to put profits in very low tax jurisdictions, and that's where the intellectual property is, and that's where the value chain is. So yes, IRS auditors, that's where the big dollars are on investigating U.S. outbound companies too.